So now if you look at this period of payback period, it's going to be 40,000 divided by $3,000. It's going to be 13.33 months only, guys. Okay, 13.33 months. That's way beyond the company's desired payback of 4 years. In this case, definitely the project will have been rejected. But let's say the company failed to realize that this machinery, once the labor would strained in this thing, and over the coming years, the cash inflow would have increased. The sales value from the 5th year might have picked up and doubled literally. In that case, the machinery, this method fails to track all the cash inflows arising after the payback period, and that's the main disadvantage of this thing. Another disadvantage is that it does not account for the present value of the money. I'm sorry, just fumbling a bit. This method does not take into account the present value of the future cash inflows. Like $15,000 coming after the end of the first year is not going to be the same is not going to have the same value as it had at the beginning of the year. $15,000 at the end of the third year definitely won't be the same as in value it sits today. So these are the major two disadvantages of this method. The present value disadvantage is taken care by the discounted cash flow analysis, which is our next method, of course, to study. But yes, this disadvantage of ignoring the cash inflow occurring after the payback period is over, after the payback period, is definitely a biggest flaw and cannot be rectified for this method. So remember, if I had told there are two more things coming up for this particular thing, particular payback period method, which I'm going to show you after the example. Now that is, over here we had the understanding that the annual cash inflow are going to remain the same. What happens when we have to choose from several alternatives? And next is that payback method under the cash flow method, under uneven cash flows basis. So as the situation arises, you need to make a choice among the different payback, apply the different methods of payback as per the situations. We're going to quickly look at this two methods over, or two situations over here, precisely cash flow from several, or choosing from the several alternatives, and payback method under uneven cash flow. I'll just try to portray this, or you can explain this thing with the help of two quick examples for this thing. So let us say choosing from various alternatives. This is also as simple as it could get. Suppose ABC company wants to buy a machinery and has two equipment choices. Let's say machine X saves $2,500 in labor and costs $15,000 to purchase. Similarly, we can say machine Y saves $3,000 in labors and cost $19,000 over here. Okay, so to compute the payback period over here for machine A, or you can say payback period is equal to the net annual cash inflow over here will be equal to the savings done by the machine. Okay, any avoidance of cash outflow in this case is as good as a cash inflow only when you're computing this payback period thing. Okay, so over here payback period will be equal to your investment for the project, investment divided by net annual cash inflow. Over here we're going to compute for machine X and this will be for machine Y. Okay, sounds good, right? So here it's gonna be $15,000 divided by 2,500, which is equal to 6, right? 15,000 divided by 2,500, 6 years. And similarly here it's gonna be 19,000 divided by 3,000. So it's gonna be equal to 19,000 divided by 3,000. A little over 6 years. So obviously machine Y will be rejected and machine X will be procured. Okay. Decision accept, reject. As simple as it can get, right? So this is how you determine which one to choose, which one to drop off. Just compute the payback period for every individual projects or purchase or whatever investment decision you need to make, and evaluate the shortest payback period. The condition over here is that if the company would have put it one more condition, that the company's desired payback period is 4 years, then in that case, both the machineries would have been proposals which have been rejected and neither of them will have been purchased. Now the other is payback method under uneven cash flows. So here we're going to put a line saying that this is over, and now we're going to pay payback period under uneven cash flow. So till now, whatever methods we have done, we have assumed that all the projects are giving an equal cash flow throughout all the years, but that does not happen generally, right? As in how the labor gets a good hand, as in how the labor gets trained on the new machinery, as in how the expertise is developed, economies of scale and various factors are achieved, the cash inflow goes on increasing or the cost goes on decreasing, or both of them take place, which happens to generate a uneven cash flow, higher in the initial years, lower in the later years, lower in the initial years, higher in the later years. Anything is possible, right? So let us look at an example where there's an uneven cash flow. Let's say an investment of $300,000 is to be made, and the cash inflow on annual basis are as mentioned, right? So for years and the annual cash inflow, you have year 1, 2, 3, 4, 5, 6, 7, 8. It's fine. I think till 8 years should be enough. For the year 1, we assume it to be on the lower sides. Let's say $30,000. Year 2 will be like, no, not too much of increase, $32,000. Year 3, let's say it's gonna be remain the same. Year 4, we're gonna have an expedited one, $38,000. How much is the total so far? It's $132. Now we can bump it up to somewhere around $50,000, $55,000. Let's say there was a shortage of materials and we had a negative cash flow or reduced cash flow. How much does this give? $289,000. And here we have something around extremely on the higher end, $90,000. So now we got to compute the payback period over here. In this case, compute the payback period for the investment. If you see, because there's an uneven cash flow on an annual basis, we cannot use the payback period formula as we have been using till now, which is the total investment for the project divided by the net annual cash inflow. What we can do is we're going to use the compound or cumulative cash inflow approach here. So we're going to compute the, oh wait, why am I writing it? It's already here. We're going to compute the cumulative cash inflow. Compute the cumulative cash inflow. I think it's getting too long, guys. Just hold on a while. We're just nearing the end. Cumulative cash inflow, which is going to be previous cash inflow plus the current cash inflow, and we're going to drop it down across, right? So it's 30,000 for the first year, second year 30,000 from the previous year plus 32,000 from the next year, that's 62,000. For the third year, 62,000 from the previous year, 32,000 from the current year, 94,000, and so on. Now we're going to see what was the initial investment, or you can say the outflow was $300,000 over here, okay? And here the $300,000 is covered over here when you have $289,000 over here. So it's obvious that the payback period is more than 6-7 years over here. And to be precise, what is the payback period? You can say you need $11,000 more in the 8th year out of its receipt of $90,000. So that's gonna be $11,000 divided by $90,000. That's gonna be 12 months. Okay. So your payback period is gonna be 7 years plus 12 is equal to 7.12 years. Your payback period is 7.12 years, and obviously you're going to reject the project because it's far beyond the company's desired rate of return of desired payback period of 4 years. This is all with regard to payback period, guys. I hope you had a good understanding of the payback period. As simple as it can get, as easy as it can be, once you have understood the principles of its application, right? I'll see you in the next session where we're going to study the discounted cash flow analysis.